Okay. So, like yesterday, we talk about cost outcome analysis. We solve some question. So we will continue. Let's solve like two more questions on this cost outcome analysis. When we solve two more questions, we now move to PSAF 4, foreign exchange transaction. After we finish foreign exchange transaction, we are going to look at one of the newborn baby in PSAF. It's a new topic in PSAF. They call it ease of doing business. It was just introduced by this new syllabus. That is when they introduced this ease of doing business. So we are going to look at it this night. This ease of doing business is talking about some of the finance act that was signed into law. So it's relating to tax, but it's one of the new topic introduced into the PSAF. So they are new and they are very important. So they are one of the physical policies tools of government. So we look at that after PSAF 4. So going to this question now, let's look at the question of my, this question 5. Oh yeah, I think we have solved this question 5. Have we solved question 5 yesterday?
No, it
No,
was
sir.
2 and 4. 2 and 4 we
Okay.
solved.
Yeah, let's look at question 5. Somebody should help us read. Oh yeah, question 5. I've shared the material already. You can help me read the question 5. Oh yeah.
Iluobi Ruling House Oriental is a small environmental organization considering the implementation of a conservation project to protect an endangered species and preserve its habitat. The data on the cost and benefit of the project are given as follows. Parameter and value. Cost of implementing the conservation project 500,000. Projected increase in ecotourism revenue 200,000 per year for the next 10 years. Estimated value of the ecosystem service provided by the habitat 100,000 per year for the next 20 years. Required, explain what the cost benefit analysis provide regarding the project's financial viability.
Okay. B part of the question.
B part says the National Health Scheme recently implemented a new intervention program aimed at reducing hospital readmission admission.
The admission.
Yes. In monetary terms, the value of hospital readmission is about 10,000 naira per case, and the program intervention cost is 1 million naira. The intervention program is documented to reduce hospital readmission by 200 cases per year. Required. Explain if the benefit of the intervention program justify its costs.
Okay, thank you. So the first one, Iluobi Ruling House. In this one, the revenue for the next 10 years, they said the revenue, they want to do conservation projects. This conservation project, what is the benefit? What benefit is it going to create in the next 10 years? It's going to give us a projected increase in ecotourism revenue, 200,000 per year for the next 10 years. So when you times 200,000 times 10, 200,000, when you times it by times 10, what value is it giving us? It will give us 2 million. Apart from ecotourism revenue, they also say it's going to create another value That means this one is benefits. Projected increase in ecotourism revenue. This is benefit. Estimated value of ecosystem service is also benefit. That one too, 100,000 per year for the next 20 years. At the end of the day, our total benefits, ecotourism revenue in the next 10 years, 2 million. Value of ecosystem service over 20 years, 2 million. That means our total benefit is how much?
That's 4 million.
4 million. Now, what is the cost? Is cost benefit analysis. What is the cost of implementation of this project? What is the cost? The cost of implementation of the conservation project is how much?
500,000.
500,000. When you compare cost to benefit, that means the benefit outweighs what?
Cost.
Cost.
The
So
cost.
just explain to them, since the total benefit is far exceeds the total cost, the implementation of conservation projects is financial what?
Viable.
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 So that is what A is asking. That is what they are asking in question A. Question B. The National Health Insurance Scheme recently implemented a new intervention program aimed to reduce hospital readmission. In monetary terms, the value of hospital readmission is about 10,000 naira per case. The value of hospital readmission is about what? 10,000 naira per what?
Case.
Per case. That value, is it a benefit or cost? Is it a benefit or cost?
Cost.
This value of hospital readmission to the hospital, to the National Health Insurance Scheme, is it a benefit to them or cost?
The benefit.
It's a benefit. For one case, when they want to readmit somebody, they collect how much? 10,000 naira, abi?
Yes, sir.
How many cases they normally do the admission in a year?
200.
So 200 times 10,000.
That is 2 million.
2 million. And the program intervention cost is how much?
1 million naira.
When you compare benefit to cost, is it viable or is it justifiable or not justifiable?
It is.
Justifiable.
So just let them know. So that is what the examiner wants you to do here. You compare benefit with cost. So that is what the examiner asks us to do. Now, let's solve one more question in this cost benefit analysis before we go to PSAF 5. Question 6. Question 6. Somebody should help us read question 6.
Say Awoshe Akinogun State of Government is considering investing in one of the 5 available projects using cost-benefit method. The following estimated costs and benefits relate to 5 different projects. Estimated cost of investment 100, 200, 120, 240. Estimated benefit are this. Assume that the state government has budgeted a sum of 520 million to be invested in undertaking the different projects required. Calculate the cost benefit ratio of each project and using other appropriate technique, rank the project and advise the state government on the project that should be undertaken and the cost involved.
Thank you. So the
Okay.
first thing we are asked to do, they asked us to do what? Cost benefit what? Ratio for each of these projects. How do we get cost benefit ratio? Benefit over what?
Over cost.
Over cost. Benefit over cost. So benefits over cost. So for the first project, is benefit cost ratio 2.5. When you divide 250 divided by 100. For the second one, 1.1. For the third one, 1.67. Why for the fifth one? For the fourth one, 1.08. For the fifth one, 1.20. That is the benefit cost ratio for them. Second thing we are asked to do, using this benefit cost ratio, they now say we should rank the projects. Based on the benefit cost ratio, let's do ranking of the project. Which one we carry first? Which one we carry first?
The first one. Okay, so
The first one, which is project A.
2.50.
Which one we carry second? The
Project C.
third one, project C.
Mm-hmm.
Why project B is fourth. So at the end of the day, you do the ranking. After the ranking, examiner also to say, advise the state government on the project that they should undertake. So we have do ranking. From our ranking, let's select project to undertake. Which one are we going to take first?
Project C.
How much is project C? Cost.
So no, 120.
Cost of project. It's not project C we are going to take first. So which one carry first in our ranking?
Project A. Project A.
A,
now.
project A.
A. What is the cost?
100 million.
So, and the benefit is 250. Which one carry second? C.
Project C.
Okay, this one is project A. Let me correct it. Project
Exactly.
A. Why second one is what? C, Abby?
Yeah, C.
The third one,
That's project E.
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 Yeah. Then B. Then G.
E.
What is our budget constraint?
500.
5 what?
100.
I think it's 500.
520.
520.
Okay.
After selecting the third project, can we go ahead?
No,
No,
we
we
have
can't.
exhausted our
So,
budget.
So our total cost, 520, total benefit. So we should advise them. They will select A, C, and E. So this is what we have on this question. We have question 4. We can lay our hand on question 4. That question 4, it's part of my, it came out last diet. So I think question 4 was out last diet. So we can lay our hand on that. And question 1 too. Please, that question 1 too is very important. Let's try. The solution is there. Let's lay our hand on it. So now we go to IPSAS 5. Called, this IPSAS 5 is called foreign exchange conversion. Foreign exchange transaction. IPSAS 5.
That
foreign exchange transaction.
we can't see the this thing, no. It just screen is blank. I don't know if it's just me, Sha.
It's everybody.
I can't see
Phone
your
is trying
screen
to
too.
switch. I can't see it too.
It's trying to save the old worksheet in order to begin a new one.
IPSAS 5, borrowing costs. This IPSAS 5 prescribe, no, it's IPSAS 4 we want to do. Sorry. Foreign exchange transaction, not IPSAS 5. Foreign exchange transaction. That is what we want to do. Let me just share. Sorry.
All right.
4 and 5 there. They follow themselves. Foreign exchange transaction is IPSAS 4. In some cases, they call it the effect of changes in the foreign exchange rates. The effect of changes in the foreign what? Exchange rates. That is IPSAS 4. This IPSAS talk about how do we recognize foreign exchange transaction in a public sector entity? How do we recognize foreign exchange transaction in a public sector entity? And how do we account for foreign exchange loss? How do we account for foreign exchange gain in this IPSAS? So when we talk about foreign exchange, this IPSAS, transaction using foreign currency, or it involves foreign operations. What we need to know in this IPSAS, first thing that we need to know is that while doing foreign exchange rate, we make use of, why doing foreign exchange transaction, we make use of accurate basis of accounting. Accurate is part of accurate basis IPSAS. And the objective of this IPSAS, which is IPSAS 4, is to prescribe how public sector entity should account for foreign exchange currency transaction and foreign operation in their financial statements. That one will take us to type of exchange rates. That one will take us to type of what? Exchange rates. There are two types of exchange rates. We have spot exchange rates. We have closing exchange rates. Spot exchange rate. This is the rate prevailing at the date in which the transaction takes place. The rate prevailing, the rate of exchange, the exchange rate prevailing at the date in which the transaction was made, the day that you purchase the good, the day that they render service to you, the day that they render that foreign service to you, or you purchase goods outside the country, you now pay in foreign currency. That day that you purchase the good, the exchange rate you use is called spot exchange rate. It is the exchange rate for immediate delivery of goods and services. Another type of exchange rate we have is called closing exchange rate. Closing exchange rate is the exchange rate prevailing at the end of accounting year of every entity. The exchange rate prevailing at the end of reporting year or accounting year or financial year of a particular entity. That is the closing exchange rate. Classification of currency. What type of currency do we have according to PSAF-4? According to PSAF-4, we have a functional currency. We also have another one called presentation currency. We have functional currency and presentation currency. What is functional currency? Functional currency is the currency of primary economic environment in which an entity operates. The currency of the primary economic environment in which the entity operates. Take, for instance, Nigeria is an economic environment. What will be our functional currency?
Petrol.
Naira.
Naira. Is Naira is our functional currency. So the currency of economic environments in which an entity operates, that is called functional currency. What are the factors that will determine a functional currency? What are the factors that will determine a functional currency? First, which currency does government use to raise revenue? Which currency that revenue is raised through collection of tax, grants, and fine? If government want to raise revenue, if government want to generate revenue, which currency does government use to generate revenue from?
Naira.
Which currency government use to collect tax? Naira. Another factor that may affect that will determine functional currency is the influence, the main influences of sales, price of goods and services. When we want to buy goods and services in market, which currency will influence the price of goods and services? Which currency are we using to trade for the price of goods and services? It's still Naira.
Naira.
So all these are the factors that influence functional currency. However, presentation currency. What is presentation currency? Presentation currency is the currency in which the financial statements are prepared, or currency in which an entity used to present its financial statements. What currency do you use as a company to present your financial statement? That is presentation currency. A company in Nigeria, they can use dollar to present their financial statement. That is their presentation currency. A company can use pounds to present their financial statement, maybe because their parent company is outside Nigeria. That is their presentation currency. Now, when we want to prepare financial statement and financial performance, when we want to prepare financial performance and statement of financial position. How does functional currency affect our financial statement? Most especially financial performance, which is profit and loss, and financial position. If you want to translate the foreign currency into our functional currency, if the item is an asset and liability item, we are going to use closing rates. If you want to prepare our financial statement, when we want to prepare our financial statement, we now have some asset and liability that are in foreign currency. And we know that our functional currency is Naira. If we want to translate or convert those assets and liabilities stated in the foreign currency to our functional currency, which is Naira, we are going to use closing exchange rates to transfer them. But anything that has to do with revenue and expenses, we are going to use spot rates, rate prevailing at the date of transaction, which is the spot rate, to convert them or translate them into our functional currency. Asset and liability in the financial position will be translated using closing rates, while revenue and expenses in the financial performance will be translated using what rates?
Spot rate.
Spot rates. So, however, in the course of translation, we may have what is called exchange differences. Exchange differences can be either foreign exchange loss or exchange gain. And our exchange differences shall be recognized as part of component of equity or net assets. So that is that. Now let's go to disclosure requirement of IPSAS 4 before we look at the question. Disclosure requirement of IPSAS 4. What are the things when we want to apply IPSAS 4 in our financial statement? When we use foreign currency, what are the things that we need to disclose when we apply IPSAS 4? When government make use of IPSAS 4? What are the disclosure requirements? Number one, the amount of foreign exchange differences recognized in the surplus or deficits, except those arising from financial instruments measured at fair value through surplus or deficit. What this number one is saying is the amount of exchange differences recognized either as surplus or deficit must be disclosed in your financial statement. The amount of exchange differences recognized either as surplus or deficit must be disclosed in the financial statement. Another one, the net exchange differences classified as part of component of net asset or equity must also be disclosed. When presentation currency is different from functional currency, the fact of the difference must be disclosed. The reason why your presentation currency is different from your functional currency. The reason for the difference must be disclosed. When there is changes in the functional currency, either the reporting entity or significant foreign operation, the fact of those changes, the reason for changes in functional currency should be disclosed. Whether you move out of Nigeria as a company, you move to Ghana, that means your functional currency will change. The reason for the change will disclose. Whether government change their currency, whether government don't want to use Naira again, they want to start using dollar in Nigeria, the fact of the changes must be disclosed. So, ladies and gentlemen, let's look at number one question. Oh, yeah.
So it reads, a public sector entity purchases equipment from a foreign supplies for $6 million on March 31st, 2011, when the exchange rate was $2 equals to 1 naira. The entity also sells goods to a foreign customer for $3.5 million on April 30th, 2011, when the exchange rate was $1.75 equals to $1 naira. As at the entity's year end on May 31st, 2011, the amount have not been paid. The closing rate of exchange was $1.5 to 1 naira. The entity's functional currency is the naira. Required: prepare the necessary journal for the above transaction. B. Calculate the exchange difference that would be recorded in the statement of financial performance for the year ended May 31st, 2011.
First, a public sector entity purchase an equipment from foreign supplier for how much? $6 million on March 31st, 2011, when the exchange rate was $2 for 1 naira. This one, if you want to raise journal on it, what is the journal for us to raise?
Equipment and cash.
We are not told they pay cash. They did not pay. They have not paid. They have not paid the money.
Account receivable, account payable.
Payables. So we debit equipment and we credit payable. Abi?
No.
The rate of exchange at that date of transaction, that is the spot rate. The spot rate is $2 for 1 naira. So, raising the journal one, equipment account. For us to convert this $6 million to naira, what do we do? Looking at the rate of exchange, $2 is giving us 1 naira. So $6 million will give us how much naira?
3 million.
6 million divided by 2.
It will give us 3 million. We debit 3 million, which is equipment account. And we credit what?
Account payables.
Being purchase of equipment as at March 31st, 2011. Number two, The entity also sell goods to another foreign customer. This public sector entity, they also sell goods to another foreign customer on April 30th, 2011. When the exchange rate was 1.75 to 1 naira. So how do we capture this? This journal, how do we raise journal for this?
Debit receivables and credit revenue.
Debit receivable and credit revenue. So $3.5 million. If we want to convert it to naira at this date of transaction, what do we do?
0.5 divided by 1.75.
It
That's
will give us how much?
2 million.
2 million. Debit receivable. And we credit what?
Revenue account.
2
Revenue.
million. Being sales of good on credits. Finally, at the end of the year, they said the two transactions has not been paid. At the end of the year, the two transactions has not been paid. And what is the closing exchange rate at the end of the year?
1.5 equals 1 naira.
You know, we are saying that we are owing, how much are we saying we are owing our payables?
300. That'd be 3 million.
3 million. As at the end of the year, is it 3 million? Are we still going to owe the person?
No.
It will have changed because of what?
The
Interest.
exchange rate.
Exchange
Closing
rate.
rate.
So let's go and know how much are we going to own this person as at end of the year. What is the closing exchange rate?
1.5 equals 1 naira.
1.5. Now, if we divide 1.5 by 6 million, how much are we going to get?
6 million. No,
To
sorry.
give us 4 million.
400,000.
4 million.
4 million.
Million.
6 million. That'll be 4 million.
4 million, Abi.
Yes,
Yes,
sir.
sir.
Yes.
That means at the end of the year, we are owing our account payable 4 million naira. Instead of how much?
3
3
million.
million.
So the difference is the exchange gain to this public sector entity or exchange loss?
It's lost.
Exchange loss.
It's a loss because assuming they are paid immediately, they will pay how much?
They'll pay
3 million.
3 million.
But they did not pay immediately. They will pay 4 million. So that 1 million, so that how do we raise journal for that 1 million? So that account payable will be 4 million. We debit exchange loss account with 1 million naira. And credit what?
Payables.
Being exchange loss on equipment. You know, when we credit this account payable by 1 million naira, that means the total value that will be in account payable will be how much?
That'll be 4 million now.
Yes,
It will
4.
now be 4 million. Because we have already credited 3 million before in journal 1. Abi?
Yes, sir.
Yes.
Now, our journal 2, the good that we sell, our customer have not paid as at end of the year. This is receivable. Somebody is owing us at the date of transaction, is owing us 2 million. Now, this person that buy this good for us at end of the year, how much is he going to be owing us?
That's how much was it?
1.5. We need to
3.5.
divide 3.5 divided by what?
1.5.
1.5.
So how much is he owing us?
2333. 2,333,000.
That's 2,333,000.
So to this public sector entity, the difference between 2 million that we say is owing us before and the 2, is it a gain or loss? Is it a gain or loss
It's a
to
gain.
the public sector
It's a
entity?
gain.
It's a
It's a
gain.
gain.
Somebody is owing you 2 million at the date of transaction. As at end of the year, that 2 million has now become how much? 233.
2.3.
So that exchange gain of 333, how do we raise Ghana for that exchange gain?
We debit receivables. We debit
We debit
receivables and credit
receivables with
exchange gain.
333, abi?
Credit revenue exchange gain.
And we credit exchange gain, which is income
233. Yeah, yes, sir.
with 333. Look at Ghana 4. Receivable 333. Exchange gain account 33333. So that is the journal. Question 2 said, calculate the exchange differences that will be recognized in the financial performance. How much exchange differences are we going to recognize in the statement of financial performance?
2 million.
In the first transaction, we have exchange what?
Loss of 2 million.
1 million. Oh.
1 million, sorry. Minus
Exchange loss of
233.
1 million, Abi?
Yes, sir.
Why
And
is the second transaction, we have exchange gain of how much?
2,333.
3,333. That
Yes,
is
sir.
the exchange gain.
Yes,
So
sir.
that means the net,
Difference.
are we going to have net exchange loss or net exchange gain?
Gain of 333. No, sorry.
Net exchange
Lost.
net exchange
Loss.
loss.
Net
Of
exchange loss.
666.
We had loss of 1 million,
Yes.
and we had exchange gain of
3,333.
333. I was calculating including the.
So that means we have a net exchange loss of how much?
666,000.
So that is what we are asked to do. That's what we need to know on IPSAS 4. So by the time we are doing revision, we will look at another question on IPSAS 4 again. By God's grace. So we are done with this IPSAS 4. It's very short. Most of the IPSAS, don't be scared. They are very short. Just for you to understand the concept and how to apply them.
But Mr. Idris, this IPSAF 4, is it realistic?
Wow, very
Yes,
realistic.
it's realistic.
It's what you do on a daily basis now.
Most organizations in Lagos, they deal with dollar because of their on border with other countries. So
yes. Because they normally import goods outside the countries.
Yeah.
Now trading activity is taking place more. So organizations are earning from investment from trading activities.
So now let's go to the next area. We call it ease of doing business. This topic was recently introduced to our PSAF, to the public sector accounting, and it's a very interesting topic. They call it ease of doing business in Nigeria. Ease of doing business in Nigeria. What ease of doing business in Nigeria we need to know here is all those finance acts that they normally pass that affect taxation. All the finance acts that government pass into law, starting that affect taxation, they are the ease of doing business. So we start by looking at, when we talk about finance act, what are the objectives of finance act? Finance act started in 2019. The first finance act. Finance act means amendment to the tax law. amendment to what? Tax law.
Tax law.
It started in
Okay.
2019. The first Finance Act we have is Finance Act 2019, followed by Finance Act 2020. We now have another one, Finance Act 2021. The last one we have is Finance Act what? 2023. So, generally, what are the objectives of this Finance Act? Why government sign Finance Act into law? The provision to provide, to put in place, to put into effect the provision of annual federal budget, which outline government fiscal policy and spending pattern. Another one, to amend the existing tax law relating to company income tax, value-added tax, to reflect current economic condition or to reflect current economic reality. Another objective of Finance Act generally is to identify measures that will stimulate economic growth through tax incentives. To identify measures that will stimulate economic growth through what? Tax incentive. It's another objective. Another one, to ensure that government has necessary revenue to fund its operation and development program. Another objective of Finance Act is to promote fiscal equity by mitigating regressive taxation and ensure fair distribution of tax burden. Another objective of Finance Act is to incorporate changes to domestic tax law so that they will align them with international standards and best practice. This Finance Act too, they also to support small and medium-sized enterprise by giving them tax relief. These are the objectives of Finance Act generally. Now, we want to be looking at this Finance Act one by one. The first Finance Act we have is called Finance Act 2019. Finance Act 2019 was signed into law in 2020, and Finance Act 2019 commenced in 2020. I think it commenced February 2020. The primary objective of Finance Act 2019 is to ensure conformity with federal government policy and generate funds in the short term to execute 2020 budgets. Now, what are the strategic objectives of Finance Act 2019? What are the strategic objectives of Finance Act 2019? To raise revenue for government through the use of various fiscal measures. To promote fiscal equity by providing palliative measures against instances of regressive taxation. Another strategic objective is to introduce tax incentive for investment in infrastructure and capital development, to support medium and small business enterprise. All these are objective of Finance Act 2019. What are the amendments made to tax in the Finance Act 2019? What are the amendments or changes Finance Act 2019 brought to the tax law? We'll be looking at them one by one. To capital gain tax, one of the changes Finance Act 2019 brought to capital gain tax is introduction of capital loss, compensation for loss of office. Under the Finance Act 2019, compensation for loss of office of 10 million naira or below is exempted from capital gain tax. When you lost your office, you are giving compensation 10 million naira or below. You will not pay capital gain tax. Another one under the company income tax is chargeable gain on sales and transfer of assets in a related parties business is exempted from tax when you transfer assets in a related party, when you transfer assets between subsidiary and parent. That transfer of assets is exempted from capital gain tax. It's one of the changes made by Finance Act 2019. Company income tax. What are the changes made by Finance Act 2019? To company income tax. What are the changes made by Finance Act 2019? To company income tax. Commencement and cessation rule was modified. The present commencement rule that we are using and the cessation rule that we are using is introduced by Finance Act 2019. Before Finance Act 2019, we have the old cessation rule that we are using. We have the old commencement rule we are using. Another changes made by Finance Act 2019 to company income tax is the issue of minimum tax. The minimum tax rate for company income tax now under the Finance Act 2019 that we are still using presently is 0.5% of the company turnover. However, when you have a turnover of less than 25 million, you will not pay minimum tax. This is public sector accounting, no? It's not taxation, no. It's in our syllabus in public sector accounting. They call it ease of doing business. It was recently introduced. So, because some people may think I'm taking taxation. It's not tax. So, another changes, let's look at changes Finance Act 2019. introduced to value-added tax. One of the changes Finance Act 2019 introduced to value-added tax is VAT compliance threshold. The VAT compliance threshold turnover is now 25 million. That means if your turnover is less than 25 million, you don't need to pay VAT on your transaction, but you need to be filing VAT.
Sir, did you say you don't need to pay VAT, but you need to be filing it?
A company that their turnover is less than 25 million, do you understand? From their turnover, they don't need to pay VAT on their turnover. They will be exempted from VAT. But they need to file a VAT return.
That is nil return now.
Yes.
Nil return, right? Nil. They will not. They will
Yes.
just file it, but they will not remit anything.
They will not remit anything.
Okay. Okay.
Part of the amendment made to VAT under the Finance Act 2019 is that tuition fee, when you pay school fees for your nursery, primary and secondary school or tertiary education, when you have a children in a private primary school, private nursery school, private secondary school, and you now pay a tuition fee, they are now telling them that they should not add VAT to school fees. VAT, tuition fee is now exempted from VAT. Before Finance Act 2019, some school, when they want to charge you a school fees, they also add VAT. Why do you want to encourage people to go to school? They are now saying that you'll be paying VAT of school fee. No, it's not allowed again. In the Finance Act 2019, there's another changes to stamp duties too. There's a changes to stamp duty. Stamp duty. Before, when you do a transaction of 1,000 naira, before Finance Act 2019, you'll be charged 50 naira. But Finance Act 2019 includes the threshold from 1,000 naira to 10,000. Now, if you do a transfer of 10,000 and above, that is when you can charge, the bank will charge you 50 naira, called electronic transfer levy. It's a form of stamp duties. In the Finance Act 2019, it was stated clearly that it is the Federal Inland Revenue and State Internal Revenue that should be collecting stamp duty on behalf of federal government or state government, not NIPOST. Because before Finance Act 2019, NIPOST and Federal Inland Revenue, they normally drag about collection of stamp duty. NIPOST believe that they are the one that will be collecting stamp duty. And they don't know that stamp duty is different from postage stamp. Postage stamp is one of the type of stamp duties. So, under the petroleum profit tax, Finance Act 2019 makes some adjustment to petroleum profit tax. Dividend paid out out of petroleum profit tax profit, upstream petroleum profit tax profit, is going to be subjected to a final tax of 10% withholding tax. Dividend paid by upstream petroleum company from their profit is going to be subjected to 10% withholding tax. What are the changes Finance Act 2019 brought to personal income tax? Pension contribution, you can deduct it as part of tax exempt without approval from Joint Tax Board or FRS while computing your personal income tax. Failure to deduct personal income tax payee, failure to deduct payee, the penalty is now 10% plus interest at prevailing commercial rates. Payment of gratuity is now part of tax exempt under Finance Act 2019. That is Finance Act 2019. Another one, now let's look at another Finance Act. We call it Finance Act 2020. Finance Act 2020. This Finance Act 2020, what is the primary objective? The primary objective of Finance Act 2020 is to bring about reform to the tax law to ensure that our tax law align with global best practice. Is to ensure that our tax law align with global what? Best practice. And again, this Finance Act 2019 also introduced the issue of digital service tax. That means taxation of digital business, taxation of online business. Anything that has to do with online business in the tax law, it was first mentioned in the Finance Act 2020. Introduction of digital service tax. Finance Act 2020 is the one that increased the VAT rate. Is the one that increased what? The VAT rate. It increased the VAT rate from what percentage to what percentage?
5% to 7.5%.
To Finance Act 2020. What are the strategic objectives of Finance Act 2020? Tax reform and modernization. Finance Act 2020 want to bring tax reform. They want to reform Nigeria tax law to align with best practice and address the issue of digital taxation and e-commerce. Revenue mobilization. Revenue mobilizations too is one of the strategic objectives of Finance Act 2019. You want to increase federal government revenue. How does Finance Act 2020, Finance Act 2020, how does Finance Act 2020 increase government revenue? It increased the rate of VAT from 5% to 7.5%. Finance Act 2020 also supports small business. Finance Act 2020 also supports small business. Finance Act 2020 also ensure that there is an economic growth and fiscal relief. Finance Act 2020, another strategic objective is it address COVID-19 pandemic response. So all these are the strategic objective of Finance Act 2020. What are the key changes introduced by Finance Act 2020? One of the key changes introduced by Finance Act 2020 is compensation for loss of office. You know, in the Finance Act 2019, they say compensation for loss of office of above 10 million is exempted from capital gain tax. Finance Act 2020 now said, apart from exempted from capital gain tax, it's also exempted from personal income tax. Finance Act 2020 reduced the rate of minimum tax introduced by Finance Act 2019. The minimum tax introduced by Finance Act 2019 was 0.5% of turnover. But because of COVID happened, tax authority want to assist the company. They now say, henceforth, starting from January 2020 up to 31st of December 2021, company, they will pay a minimum tax at a reduced rate of what? 0.25%. Instead of the rate of 0. What? Instead of rate of 0.50%. But for 3 years after COVID-19, January 2020, starting from January 2020 up to December 2021, that is for 2 years, sorry. Finance Act 2020 also made an adjustment to donation. One of the adjustments Finance Act 2020 make is when you donate for natural disaster or COVID-19, subject to that, your donation is no more than 10% of your adjusted profit. That donation is allowable. When you donate to COVID-19 relief fund, and if the donation is no more than 20% of your accessible profit or adjusted profit, that donation is allowed. Finance Act 2020 also introduced what is called gross income. And he said gross income means when you add all earned income plus unearned income, you less earned income plus unearned income, it gives you total income. And you now less tax exempt. When you less the tax exempt, you get your gross income. It was Finance Act 2020 that introduced it. Finance Act 2020 also said somebody earning minimum wage will be exempted from personal income tax. Minimum wage earner, minimum wage, and income earner earning minimum wage or less will be exempted from personal income tax. It was Finance Act 2019 that introduced it. Finance Act 2019 also exempt airline tickets, commercial airline tickets from VAT. Before, if you go to the airport, you buy a ticket, you want to travel to UK, you buy a ticket, you will see they will add VAT to it. But as from 2020, airline ticket is exempted from VAT. Finance Act 2020 changed the name of electronic bank transfer. It changed the name. It changed it to what is called electronic money transfer levy. And he mentioned that this electronic money transfer levy is going to be shared between federal government and the state government. Federal government will collect 15% and state government will collect 85%. So let's look at Finance Act 2021. Finance Act 2021. Finance Act 2021 were to support implementation of 2022 federal government budget and to address the economic impact of what? COVID-19 pandemic, recession. What are the strategic objectives? The strategic objective is to support 2022 budget, to raise revenue for 2022 budgets. Another strategic objective is to address economic impact of what? COVID-19. To address economic impact of COVID-19. Another strategic objective is to raise revenue, to raise tax revenue to government. Why another one is to do what? To amend Capital Gain Tax Acts, where disposal of share in essence of that is not more than 10 million, 100 million naira will be exempted from capital gain tax. But when you dispose share that is more than 100 million naira, it will not be exempted from capital gain tax. Another objective of Finance Act 2021 is to increase the rate of tertiary education tax from what percentage to what percentage? From 2.5% to from 2% to 2.5%. All these are the objectives. What are the key changes to Finance Act 2021? What are the key changes to Finance Act 2021? One of the key changes to Finance Act 2021 is capital gain tax at the rate of 10% is now paying on disposal of any share, in disposal of shares in Nigeria. But if the value of the share is not more than 100 million, it's exempted. But if the value of the share is more than 100 million, it's subjected to capital gain tax. That is one of the changes he made to capital gain tax. For company income tax, Finance Act 2020. What are the changes he made to company income tax? Profit of a company from export of goods and services produced in upstream, midstream operation is now liable to tax. Capital allowance incurred on qualified capital expenditure in generating a tax-exempt income is not deducted from the assessable profits. Another changes. Let's look at what changes Finance Act 2021 brought to tertiary education tax. The Finance Act 2021 increased tertiary education tax rate, upward review from 2% to 2.5% of assessable profits. Finance Act 2021 also under tertiary education tax. The time limit for payment of tertiary education tax has reduced from 60 days to now 30 days. This was introduced by Finance Act 2021. Finance Act 2021 also introduced another type of tax called Nigeria Police Trust Fund Tax. Nigeria Police Trust Fund tax was introduced by Finance Act 2021, which is 0.05% of net profit. Finance Act 2021 also brings changes to value-added tax. What are the changes Finance Act 2021 bring to value-added tax? Non-resident company that supply goods and services, they now have obligation to collect, remit tax. Non-resident company supplier of goods and services have statutory obligation to collect and remit tax. Finance Act 2021, one of the changes he made to VAT is exclusion of upstream petroleum operation under Petroleum Industrial Act or Petroleum Profit Tax Act from 25 million threshold for remittance of VAT. So Finance Act 2023. Let's look at Finance Act 2023. What are the objectives of Finance Act 2023? The objective of Finance Act 2023. Finance Act 2023 become effective in September 1st, 2023. And they want to use it to implement 2024 budgets. It focuses on revenue generation to government, tax equity, and it brings about clarity in the tax law. So let's look at the strategic objective one by one. Strategic objective of Finance Act 2023, implementation of 2024 federal government budgets. Implementation of 2024 federal government budgets. They want to use it to implement, to get revenue to finance federal government budget for 2024. Amending existing tax law is one of the strategic objectives. Some of the existing tax law was amended. Revenue generation and tax equity. They want to use it to generate revenue and ensure that there is equity in taxation. Now, what are the key changes Finance Act 2023 made to the tax law? One of the key changes in the area of tertiary education tax, Finance Act 2023 increased the rate of tertiary education tax from 2.5% to how many percent? To 3%. Finance Act 2023, one of the changes he made to capital gain tax is when you make a capital loss, that your capital loss can be deducted against future capital, against future chargeable gain. When you make a capital loss or chargeable loss, that your chargeable loss or capital loss can be deducted against future capital gain. Finance Act 2023 also recognize the importance of digital economy, the importance of those who are doing business online, digital currency, cryptocurrency, digital assets, online gold, Twitter, Facebook. Finance Act 2023, one of the changes he made to company income tax, he deletes an allowance called investment allowance. Finance Act 2023, one of the changes he made to company income tax is deletion of investment allowance. So, ladies and gentlemen, this is most of the changes Finance Act 2023 brought to the tax law. This is an amendment. So, what you are asked, what I will expect you to do in this material, this is one of the new topics. We have like 3 questions here. Please go and study the question. The solution is there. There may be likely examinable question because this is one of the new topic introduced to public sector accounting. So most of those new topics, at least 2 of them will come out. That is how I can do. 2 will come out. So this is one of the new topics. Ease of doing business was just recently introduced to our public sector accounting and finance. I have a question, examinable question. Let's take your time, study the question. For our VI student, write the question in your notes, provide the solutions too. Write the question and solution in your notes. It's part of your reading. It will make you to understand this topic very well. You can see the question live and direct in the exam. So if I were you, I would just print this material, look at the question, write it, and write the solution in my notes. When I'm reading, it will be very easy for me, rather than strolling on this my pack or looking at phone. So we have question 1, question 2, and question 3. So somebody asks, can you help us indicate the new topic on this group? I will help you. Maybe by Friday, by God's grace, we are going to look at another new topic called Sustainable Development Goal. Sustainable Development Goal is another new topic. Public Accountability Index too is another new topic. Sustainable Development Goal is going to be our next topic. We may look at it on Friday. If we don't look at it on Friday, that will be Saturday morning. But for our VI student to take advantage of it, we may look at it on Friday night. Sustainable Development Goal, SDG. We have another one called Public Accountability Index.
Sorry, Mr. Yusuf, you say Friday night, VI students. You used to come on Sunday now.
I'm talking of online lecture, my friend. Online lecture. Online.
For VI students?
Yes, both VI and the online student. Yeah.
And you will come on Sunday again?
I will come on Sunday. You don't want me to come?
For a different topic.
You don't want me to come?
We want you, sir.
Please come, Jerry.
Oh, thank you very much, my good sister. So any other question?
It's a sunshine lady.
I have a question, sir.
Oh yeah, go ahead.
Please, you just mentioned that Friday is for online student in VI. Sir, we usually have
both our online students too. Anytime we want to do online lecture, we put our online student too.
I think we usually have you on Saturday, 8 to 10 a.m.
Yes, don't worry. I will communicate. Don't worry. Yes, don't worry about that. Okay, so any other question? So my VI students, when I'm around on Sunday next week, we solve question on local government accounting, and we look at some other area of IPSAS. So we solve question on local government accounting. So most of the theory, if time permits us, we do one of them on this Friday night. STG, Sustainable Development Goal, we may do it on Friday night, including the online students. So thank you for having me. Enjoy your weekend. You want to ask a question?